Hi everyone, welcome to another webinar from APM Capital. We're very pleased to have with us today Tariq Dennison for the second of three in a series of webinars. And just as I let people join on, I'll just give you guys a little background about APM Capital in case this is the first time that you've encountered one of our webinars. We are a broker which was established in 2021. We are headquartered in Abu Dhabi. We're authorized and regulated by the FSRA. And we like to give our clients the best trading experiences that they can have. We offer our clients CFDs and foreign exchange via MT5, but we also connect our clients to the world's derivatives exchanges. Principally, and the event partner, which we're very grateful about, is the CME Group. Maybe not the biggest, but definitely the most diverse and most trusted, I would say, derivatives exchange in the world. And we have clients trading on their futures and options. And we're very pleased for their participation in this event. Just introducing Tariq. Tariq Dennison is a wealth manager and investment advisor who's based in Switzerland and is registered to manage investment accounts in Hong Kong, the US, under the GFM brand. Tariq's passion is helping multinational families and professionals build and maintain robust portfolios of income-generating assets and financial plans. He served at wealth management divisions of Societe Generale in Hong Kong, CIBC in Toronto and London, and at Commerzbank, Stearns and JP Morgan in New York. He holds a master's in financial engineering from the University College of Berkeley and has taught master's level fixed income and alternative investment course at ESSEC Business School in Singapore. And we're very, very grateful to have him with us. So without further ado, please take it away, Tariq.
Thank you very much, Mark, for that kind of introduction. I think many of you knew when you registered for this webinar, and as you'll see on this slide and the next title slide, this is all about the Bitcoin Friday futures, partly introducing you to the CME Bitcoin Friday futures contract, but also introducing you a little bit to APM Capital for any of you who are new to it. I admit I'm relatively new to it as well, and finding out more about it each time. Just before we started this call, in fact, talked about a corporate account I might be opening that I'm going to be looking into. So today's topic, as mentioned, CME Bitcoin Friday futures. This is another one of my AI-generated cover photos, which I'm sure could artistically be a little bit better. I wanted to say, give me a picture of Bitcoin and Friday. What's the whole deal with Friday? Well, one of the biggest problems we've seen with Bitcoin futures contracts is the distance between the current Bitcoin price and the price of the futures contract, as I'll show a little bit later on. We'll show how having contracts that expire every week rather than every month shortens this and makes a much more efficient, better, faster, cheaper trading instrument. Before I continue, let me start with a very important disclaimer for me and my firm. And Mark was already kind enough to mostly introduce me. For those of you who would rather read than listen about my bio, here is a summary of me and what my background is. As he mentioned, I'm a account manager. I basically manage clients' investment accounts in Hong Kong, Europe, and in the US through 3 different licensed entities. My experience covers futures and options, but also stocks and bonds, also commodities at a variety of firms, pretty much in every region of the world. And my 2 books that I've written, the covers are down there at the bottom. The first one is Invest Outside the Box, which came out in 2018. The other one is 10 Ways to Invest, which if you look up my LinkedIn profile, the physical copies of just came out last week. And I'm very excited to get copies of my second book in the hands of as many people as possible. So that's a little bit more about me. You can also look me up on Seeking Alpha, CNBC Asia, the Asia Times. I am very prolific in writing and speaking and doing webinars because, as you'll probably hear from how I describe things, I'm very, very passionate about financial topics. So what are we going to talk about today? I think one challenge I have with these webinars is that you probably come from a wide variety of backgrounds. Some of you are already very experienced futures traders and you want to know a little more about Bitcoin. Some of you are probably very experienced crypto traders, probably really understand Bitcoin, Ether. You want to understand why should you use Bitcoin futures. Some of you may be pretty new to the whole thing. You may want to make sure you understand a little more about Bitcoin, a little more about futures. So please be patient with me if you're in one of the more experienced cohorts. I'm really going to start from the beginning and talk about some of the fundamentals about what Bitcoin is, what do you need to know to understand about it, what are some of the drivers of Bitcoin prices, what drives Bitcoin prices up and down, and why might you want to take a long or short position. Then when I talk about trading instruments, I'm going to be comparing the three main ways that many of you might consider trading Bitcoin. The one we're talking about today, of course, is Bitcoin futures, specifically Bitcoin Friday futures. And I'm going to compare that with trading physical Bitcoin versus one of the biggest topics this year, which is Bitcoin ETFs. Some of the main large ETFs that launched in the US this year by BlackRock and Grayscale, several other providers. Why should you trade Bitcoin using an ETF versus with a futures contract versus just trading it directly? When I talk about the futures, I'm also going to say what's new about these Friday futures. How are they different than the old monthly futures? And then I'm going to provide some samples of specific trades, trading strategies you might consider. So let's go ahead and get right into it. First of all, where is Bitcoin in the whole crypto picture? And the nice thing about crypto is that there's lots of websites, lots of information out there if you want to learn more about it. The hard part about it is, of course, a lot of it I don't think is terribly high quality. You've really got to filter through and and look and say what information is good. One of the sites I check in every now and then is a site called coinmarketcap.com. This pretty much tells me what the largest crypto coins out there are by market value. Kind of like looking at the top holdings of, say, the S&P 500 or any large stock index, tells me what companies are trading and are the most out there. As of now, Bitcoin is by far the single largest cryptocurrency, by a mile. It has a market value of about $1.2 trillion. That's trillion with a T, making it quite a bit larger than many entire stock markets or many economies. So it's big, it's significant. You can see that's with a circulating supply of 19.7 million Bitcoin out of a maximum of 21 million that will ever be mined. That's by design. The second largest crypto coin out there is the Ether token, which the Ethereum network runs on. That has a market value of a little less than 300 billion right now. There's currently no hard ceiling on Ether, so conceivably Ether could become more valuable, although it could do that with less price appreciation as that could get diluted among more and more Ether tokens. Then going further down, Tether and USDC, number 3 and number 6, are stable coins that are basically pegged to the US dollar. That's why their charts don't really move too much. And then you've got several other tokens there, the Binance BNB, Solana, Ripple, which is XRP, Dogecoin. Each of these have different use cases and different drivers. I really think if you want to understand any of these, you need to understand Bitcoin first. So today we're going to keep focused on Bitcoin. So if you want to understand the basics of how Bitcoin works, what makes it scarce, how Bitcoin transaction works, what makes it secure, how we're able to transfer value without having a bank or a central entity, I actually highly recommend one single YouTube video, which does a much better job of this than I ever will. And I've probably watched 100 YouTube videos on Bitcoin. This one is by far the best. It is from a channel called 3 Blue 1 Brown, who mostly does math explainer videos. And what I like is just how clearly he explains certain things. And here he talks about what does it mean to own a Bitcoin and how is it that I'm able to send you a Bitcoin and not make a copy of that and send it to something else. This is all done through a decentralized ledger called a blockchain. The blockchain is basically a sequence of transactions which uses cryptography to make it impossible to forge that series of transactions. So by having it out there, anyone can look at it, anyone can submit a transaction, and then you have what are called miners who do complex math problems to basically stamp the transaction and verify that my transfer of this Bitcoin to you, your transfer of this Bitcoin to Alice, this transfer of this Bitcoin from Alice to Bob, is all done, has been verified, can never be double spent on every single one of these blocks. Now, the way to think of one of these blocks is kind of like to think of a daily transaction ledger that a bank might have. If I were to send you $50 and then you were to send Mark $25 and we were to split dinner and we were to all do it through an app on the same bank, well, then the bank in their database would have, okay, my transfer to Mark, $50, Mark's transfer to Alice, $25. That would all have to be kept somewhere. How do we do that without having a bank? Well, basically, you have this database, kind of almost like a public website, where these miners are all the time running transactions that basically have, let's say in this first block, Alice pays Charlie 50 LD, and this video says LD is ledger dollars. And there's a signature, which means only Alice could have authorized that transaction. And then Charlie pays you 40 ledger dollars with a signature, and only Charlie could have authorized that transaction. That makes sure that your money can't be stolen. It also makes sure that you can't double spend any money. And then this proof of work is what goes down at the bottom through what is called mining. Now, basically what it is that the miner has to basically guess a number, has to go through billions and billions of numbers, so that if I take the previous hash and all the transactions and add it up, the signature ends with a certain number of zeros. That is something that you're not able to solve as a simple math problem. You can only do it by guessing billions and trillions of numbers, which is why you have Bitcoin miners using enormous amounts of electricity, just running these computations over and over and over again. And what they do is that they solve for this proof of work. That's basically the number that makes this problem add up. And as part of the transaction, they get to award themselves a certain block reward. So that was a lot, that was a mouthful. As I said, this video explains it in more detail than I do, but this is how you have a public record of cryptographically signed transactions, which can be out there in public, everyone can see it, but only the person who has the private keys to your Bitcoin wallet can actually send that Bitcoin to someone else. Now, you can imagine what the problem is. If it's decentralized, there's no one bank, there's no one place. How do I know which ledger might be? What if I send, Mark $50 here and someone else sends $50 over there and there's two different records? Well, what I do is I just wait and I listen and I look for whichever of the blockchains is the longest. And if you're a miner, you're only going to get the blockchain reward if you are adding to the longest blockchain. So this gives all the miners the incentives to look at the last chain, to put all their work into trying to find the proof of the work to create the last link in that longest chain. And when the next transactions are sent, the miners are going to compete again. So this is the process that is on and ongoing. Basically maintaining this single public ledger is the competition of lots and lots of computers with lots and lots of computing power. So a little bit more about how mining works. So as mentioned, it starts with the previous hash. The hash is kind of like a signature, or it's something that can only have come out of the last block in the chain. So if any transaction in the previous part of the chain, let's say I tried to go back to block number 50 and say, no, I didn't send Mark 50 Satoshis, I sent him 30 Satoshis. Well, that would change every subsequent hash, and then the next hash here would be invalid. So that cryptography is what makes sure that once a transaction is printed on a block, it is irreversible, it can never be changed. Now you take that hash, you add all the transactions that are going to be included in the block, you add the proof of the work at the end, and then you run it through an algorithm called SHA-256. And as mentioned, if the result of that is that you get a hash, a signature that starts with a certain number of zeros, then congratulations, you've mined the next block, and the miners will then take that and start working on the next block. And basically that little highlighted part at the top, that yellow part, which says the block creator gets 10 ledger dollars, that is the mining reward that you see at every single block. So that's why people would spend millions of dollars on servers to go mine Bitcoin. It's because when they solve this problem, when they get the proof of work in, they get to award themselves whatever that block reward is, which it used to be 25 Bitcoin, which is a lot of money, and then it would have to 12.5, and then 6.25. So that's the next thing we're going to get to is the halving, how that works. So every roughly 4 years or so, and we'll look at a calendar for this, the design of the Bitcoin network is that the reward that a miner gets for mining a Bitcoin gets cut in half. Initially, it was 50 Bitcoin per block. Then it got cut to 25. Then it got cut to 12 and a half. So what that does by design is you cut it in half and half and half. By roughly the year 2040, the Bitcoin rewards will basically go to zero. And the maximum number of Bitcoin of 20 million will have been mined. Now, if you have a fixed supply, what that does is it reduces the inflation rate. In fact, arguably, it makes Bitcoin deflationary. That's why many people say Bitcoin is kind of the new digital gold. In fact, in some ways, it's better than gold, because one problem with gold is that an asteroid could fall from the sky, or we could discover a new reserve and suddenly find there's a lot more gold than we thought. But by design, there will only ever be 21 million Bitcoin. Now, the flip side of that is there could be many more cryptocurrencies. Ether could take over, or Solana could take over, and we could all decide that we're not going to use Bitcoin, we're going to use Solana instead. That's the bigger risk to Bitcoin, is that there will be other cryptocurrencies. But by design of the algorithm, there will only ever be 21 million Bitcoin. Now, if you were to contrast that fixed supply of 21 million Bitcoin to the supply of US dollars, this is the difference. I mean, it's almost no comparison. The US almost every single year prints more money. That's how inflationary monetary policy works. Now, printing money is not physical printing press so much. It's more the central bank, when it expands credit, goes and increases the number of dollars that member banks have on reserve. Those member banks can then go lend it out and create credit. That expands the number of dollars in circulation. That especially spiked in 2020 and 2021 with the COVID stimulus. It's come back a little bit as the Fed has tightened since 2022. But overall, the long-term trend for the dollar is there are going to be more and more dollars chasing roughly the same numbers of goods and services, and that's why we have inflation. Bitcoin, by contrast, is meant to be a deflationary currency rather than an inflationary currency. Now, earlier I mentioned Bitcoin halving. So how does this work? Every 210,000 blocks, and on average, a block is about every 10 minutes. So again, this is by design. If more computers come, throwing more computing power at the network, the algorithm will automatically adjust the difficulty of the proof of work problem. So let's say, for example, we only required 10 zeros at the beginning, and now more computers are coming on so that they could solve that problem in 5 minutes instead of 10. They'll just say, okay, now we require 11 zeros or 12. The algorithm will automatically adjust it so that no matter how much computing power gets thrown at it, it will take about 10 minutes per block. So 210,000 blocks means about 2.1 million minutes, or about 4 years. The last halving occurred earlier this year, around April 20th, when the price of Bitcoin was around 64,000. That changed the reward per block from 6.25 Bitcoin to 3 1/8 Bitcoin. So that means you go and you throw all of this work, and then you happen to win. You get that one block, and then your reward in that block is 3 1/8 Bitcoin, which at 64,000, that's around $200,000. So that's really what you need to weigh in to whatever your cost was for going and mining that one Bitcoin block. So all the miners who are competing, that's what the reward is. And then by 2028, that reward is expected to go down to 9/16 of a Bitcoin. Sorry to do the fraction there, but it's basically getting cut in half and half and half that way. And you'll see as the block reward comes down, the percentage of all eventually mined Bitcoin will approach 100%. Right now, it's around 96%. That, in a nutshell, is the supply side of the whole Bitcoin money supply. Now, another one of the good charts I look at is this chart by macromicro.me. There's a lot of other charts like this, which basically shows that the long-term rise in Bitcoin prices has been it looks very highly correlated to the rise in the cost of mining. So as I mentioned earlier, if more computing power gets thrown at the Bitcoin mining problem, the algorithm will automatically make the problem harder. And on the other side, the mining rewards are getting cut in half every 4 years. That means that on average, more and more computing power is going in to receive less and less Bitcoin. That means the mining cost per Bitcoin is going up steadily over time. That, quite simply, is what drives the chart that pushes up Bitcoin prices, is because the supply more or less remains fixed. If the demand goes up, the price will go up with it. So the biggest risk by far to the price of Bitcoin is that demand will collapse. If suddenly enough people realize, you know what, this is a very energy inefficient way of managing transactions. Let's all go to Solana or ADA or some other crypto coins, or let's go back to centralized banking. Then you won't have the demand side for Bitcoin, and you'll have a bunch of computers wondering if it's worth still mining it. That's what the bottom part of this chart shows. It basically shows the ratio of average mining costs to Bitcoin prices. So one strategy, not necessarily a recommendation, not a recommendation, is you could look at what the relative cost of a coin is versus the mining cost, and you could consider Bitcoin undervalued when it's below, and you can consider it overvalued when it's above the average mining cost. So that again is one way of looking at the fundamental driver of Bitcoin prices. Another thing which I don't think a lot of people appreciate is that Bitcoin transactions are public. So in other words, whenever you send someone a Bitcoin or a tenth of a Bitcoin, I can actually go on the blockchain and see which block that transaction was, which wallet sent it to where. And because of that, there's a lot of public transaction data. So this one, for example, I pulled up on October 6th from a site called bitcoininfocharts.com/Bitcoin. It showed over the last 24 hours, there were a total of 611,000 Bitcoin transactions, an average of 25,000 per hour, which if you compare it to a network like Visa or, that's actually nothing, because Bitcoin transactions are still a little bit, heavyweight. It shows you the volume in terms of number of Bitcoins that were sent, the average block size, the reward per block, etc. And overall, what you can see is that most Bitcoin transactions are actually relatively small. There are a lot of Bitcoin transactions that are, less than 1 Bitcoin, 0.1 Bitcoin or 0.2 Bitcoin. Not a lot of really large transactions. But at the same time, several years ago, I used to use Bitcoin to actually buy pancakes from one of my favorite pancake places in Hong Kong. You're not seeing a lot of transactions of that size anymore either. You also want to look here at the wealth distribution. The top 10,000 addresses hold more than half of all Bitcoin outstanding. So that, again, something to keep in mind when you look at what the overall Bitcoin economy, if you want to call it, looks like, and if you're going to participate in it, what your position looks like. On the left, we have some statistics for what the latest blocks are. So what you can see, the height is basically how long the blockchain is to that specific block time. So over there, you see block number 863,817, which was mined on the 2nd of October at 15:06:34 Greenwich Mean Time. You see what the kind of the sum was and the number of Bitcoins included in that transaction. That basically is the entire Bitcoin transaction network there for the world to see. And when you look at the richest addresses, that's there on the right. Those public keys, if you wanted to send the richest Bitcoin billionaire on the world Bitcoin, you could send it to that address. But if you wanted to steal that Bitcoin, you would need to crack the private key of that address, which would probably take you all the computing power in the world for about the next billion years or so. So that, in a nutshell, is a sampling of all the public data you can see there if you want to go at it and build your Bitcoin trading strategy off of that. Now, I want to get past the fundamentals and look into price volatility and trading strategy. This chart right here gives you a picture of how volatile a commodity we're talking about here. So this is just the past 5 years from COVID, around the time when Bitcoin was swinging from $3,000 to $10,000. Then at the end of 2020, it went from kind of the mid 5,000s up to 40,000. Then during the FTX scandal last year, it went up to around 15,000. Now it's up to 60,000. So in short, this is an extremely volatile asset. If you were to compare this to any stock, any other financial asset, this goes up and down a lot. I mean, we're talking about, doubling or 5xing in price in a short time or falling by 80%. That's just a normal year for Bitcoin. So this is not something to get into if you were at all scared about volatility. Very, very important that you watch your risk management very, very carefully on this, especially when you're using futures, which allow a bit of leverage. So that was part one. Those are the fundamentals and some background on Bitcoin and what it is we're going to trade with these instruments. Now let's look at the trading instruments. First of all, I want to mention for any of you who actually want to get on the blockchain and trade physical Bitcoin, I highly encourage anyone who's going to do it to actually trade some physical Bitcoin. It does trade on many exchanges. Some of these are regulated, some of these are not. I've already mentioned some of them, like Binance, for example, but you may also know Coinbase or Kraken or Gemini. I mean, there's lots of these different exchanges you can go and look at, and you can buy or sell Bitcoin on. Trading is effectively 24/7. Now you can trade it in pretty much any size. There's different fees and spreads to watch out for. It is still kind of a Wild West market compared with futures. Futures are highly regulated, and you're pretty much going to get institutional pricing. Much easier to get ripped off on a private exchange. Two famous examples of rip-offs were Mt. Gox, and FTX. One thing to keep in mind with trading on an exchange, not your keys, not your coins. If you buy Bitcoin on an exchange and you leave it on an exchange and the exchange steals it, well, that's a risk that you have. If you're going to trade on an exchange, your goal is to take that Bitcoin off the exchange and get it on one of these hardware wallets that I have a picture of over here. Not necessarily endorsing any of these, but that's the way to keep your physical keys so that you have control over the transactions and they can't get stolen. Now, what are some different ways of trading Bitcoin? Let's say you've got a view on where Bitcoin is now. You think it's going to go up. You think it's going to go down. Should you use the ETF or should you use futures? Well, if you want to trade a Bitcoin ETF, you need to put down the full value of the Bitcoin ETF position in cash, or you need to borrow it on margin, on that day. So your limits of how much you can buy, your limits on being able to lever up are limited. If you want to sell short, you're going to need a stock loan facility. You're going to need to pay for stock loan. You have the worry about those shares getting called. All the issues with selling a physical security short. If you're buying a US Bitcoin ETF, don't forget it's a US situs asset and may be subject to US estate taxes. All Bitcoin products, exchange traded products, do charge expense ratios. So for the privilege of them getting to hold your keys, they're going to charge you for that, and that's going to come out pretty much every day from the product. And you're limited to only trading during exchange hours. So you got to do all this work to get the money in, and then you trade Monday through Friday when the exchanges are open. Now, on the other hand, if you trade Bitcoin futures, you only need to put up the initial margin and then click long or short exposure. You pretty much get it with a click of a mouse. You don't need to pay up fully for it. You don't need to borrow on margin. You don't need to borrow any shares to sell short. In my view, for any price trading, futures are the simple one-click instrument. Also, your US estate tax exposure is limited to whatever you have on margin. And if you're trading with a non-US broker like APM, that doesn't even enter in the picture at all. It's pretty much a non-US brokerage account. Futures contracts are not securities, no US situs asset there. That's just a much, much cleaner offshore trading vehicle. Your costs of the futures contracts are shown to you in very clear black and white terms when you trade. So you don't have any bleed from that ETP taking out an expense ratio over time. And Globex is open from Sunday through Friday from 5 p.m. to 4 p.m. the next day, Central Time. So not quite the 24/7 trading of direct crypto exchanges, but pretty darn close. And especially if you want institutional pricing, you want to be able to go short. Bitcoin futures, in my view, are the simplest instrument for doing that. What are the specs of some of the Bitcoin contracts you might be looking at? Now, if you go to the CME, you'll see there are three sizes of contracts. There are the original Bitcoin futures, which are 5 Bitcoin per contract, which at 61,000 is $300,000 worth of Bitcoin per contract. That's large, so if you want to trade in size, that could be the contract you want to use. There's also a micro Bitcoin contract, which is 1/10 of a Bitcoin per contract, so about $6,000 per contract. that also works, and those mature on a monthly basis. So that may be more manageable if you've got a longer term strategy and you're not as worried about the carry that we're going to be talking about. But what we're talking about here is the Bitcoin Friday futures contract. One benefit I'm going to mention is, of course, the short expiry time, but the other big benefit is the very small granular size. One Bitcoin Friday futures is only 1/150th of a Bitcoin, or 0.02 Bitcoin, or a little over $1,000 at current prices. So that really allows you very granular exposure to Bitcoin prices if you want. You can decide pretty much exactly how much you want to put on. The maintenance margin per $1,200 contract is around 300, so you do get some leverage, nowhere near as much as you'd get, say, in a stock or bond future. But I showed you how volatile Bitcoin was. Still very, very easy to lose all your money in Bitcoin futures very, very quickly. One thing I'll also share, on October 1st, when Bitcoin Friday futures were launched, the CME Group did say that it was one of the most successful cryptocurrency product launches, even by their standards. There were 31,498 contracts traded across 2 different contract weeks. Contract weeks are the expiry dates that we're going to look at next. So overall, I have very little doubt that there's going to be good liquidity on these contracts, even in relatively small size. So what do I mean by kind of the carrying cost or the roll cost? Before the US Bitcoin futures launched earlier this year, there were ETFs. There were ETFs that tracked Bitcoin futures. And one of the things you'd noticed is that the price of those Bitcoin futures ETFs underperformed the price of actual Bitcoin. And the reason for that was the roll costs. Now, what are roll costs? Here on the top, I have the micro Bitcoin futures, where I showed a quote at the same time for the October future and then for the November future. Now, if you look at that little arrow I drew, you notice the October future was 61,530 versus the November future, which was 62,360. If you want to maintain a continuous long position in Bitcoin futures, you're going to need to buy the October futures, and when the expiry approaches, you need to sell the October and buy the November. And then when November approaches, you need to sell November and buy December. Every single step up that curve is going to cost you money. Part of that is because of interest, but there's a lot of other reasons why this Bitcoin futures prices in such a high basis. One of the reasons for the Bitcoin Friday futures contract is that it splits up that cost. So instead of you having to pay that whole however many points, so $820 per coin per month, it breaks it down to about $190. So from 61,110 to 61,300 over the course of 1 week. Now, here you got to be a little bit clever when you click in. You'll notice the 404. So what that means is this is October 4th of 2024 versus the next one is October 11th. So you're pretty much looking at every Friday in the month of October, you've got one of these expiring. And so you can look at the exact date when I say, okay, I want to get exposure until this next Friday, which is the 18th. So I'm going to buy the 18th future, and then I'm going to roll it to the 25th future, and so forth like that. So besides the smaller size, the other advantage of this is a much more granular breakdown of that futures cost. Now, for anyone who's new to futures, very quickly, you basically deposit, say, $1,000 in your margin account, or maybe you need to put a little bit more here. You buy one of these micro contracts at 62,000. The price goes up to 67,000 at 0.0 times 0.02 Bitcoin. That means $100 gets swept into your account. You now have $1,100. Then if the price comes down to 57,000 times 0.02, $200 gets swept out of your account. Your margin balance goes down to 900. If you are new to futures, please make sure you master this chart before you put on any long futures position. This next slide is basically the mirror image of the previous one. This is if you wanted to bet that Bitcoin prices were going to go down. So again, you put $1,000 in your margin account, you sell one Bitcoin futures contract. So you don't need to borrow anything or anything. You just click sell. You've got a short position in one Bitcoin. Price goes up. You lose, $100 gets swept out. You now have $900 in your margin account. Then eventually it comes back down. You were right. $200 gets swept into your account. you now have $1,100 in your margin account. So, like I said, whether you're going long or short, take this slide and the previous slide, print them, put them up on your desk. Make sure you've mastered how this works before you trade futures. Now, some futures terms to know, I've mentioned these earlier. First of all, the basis. The basis is the difference between the price of whatever you're trading and the futures price. So if Bitcoin right now is trading at 60,000 and the futures is at 61,000, that basis accounts for interest on the $60,000 between now and expiry, accounts for the fact that whoever's on the other side is going to need to store that Bitcoin, maybe has some insurance costs, maybe just gets to get away with it because a lot of people want to lever up Bitcoin futures. So that's a basis that you really need to watch out for, because if you're long right now, you're paying that basis. If you're short, you're earning that basis. Settlement price, on the other hand, is the daily closing price I showed you earlier, where it's going to look at that price versus where you bought it or sold it, and it's going to sweep that difference into and out of your account on a daily basis. Open interest is the total number of outstanding contracts, and by definition, the number of longs equal the number of shorts. So if you see $50,000 of open interest, which I think it showed here, it doesn't show open interest. It just shows volume. But that gives you an idea of how much a contract is traded. Initial margin is going to be larger than the maintenance margin. So earlier I said $800. You're probably going to need $1,500 or $2,000 to get into one of these contracts. And right now, all Bitcoin futures are financially settled, meaning there's an official settlement price and dollars get settled in or out of your account. You are not going to receive physical delivery of Bitcoin through your APM account. So what are some strategies you can use? Well, the first and most obvious one is if you think Bitcoin's going to go up, you buy Bitcoin futures. If you think it's going to go down, you sell Bitcoin futures. That's the very quick and simple one-click exposure to long or short. Another strategy I want to kind of get in your mind, not a recommendation, is if you buy physical coins and you store them on your hard wallet, and then you sell those futures at a premium, you're basically getting to pocket that basis. So again, take earlier, I can buy Bitcoin on a physical exchange for 60,000, and then I sell one of these futures contracts at 61,000. I basically get to earn that $1,000 between now and when that futures contract expires. That's an interesting carry trade for anyone who can do both sides of that. And I actually would like to see more people doing a trade like that. The other one would be a cross-market spread. Now, this is a more advanced strategy and a riskier strategy, because here you're trading Bitcoin futures versus, say, Ether futures or gold or whatever other asset. But as you can see here, the sky's the limit. I've just tried to provide you all the instruments you might need to put together your own Bitcoin future strategies. If you have any more questions, my name is very easy to find. I'm the only Tariq Dennison in the world as far as I know. You can find me on Seeking Alpha, X, formerly known as Twitter, or on YouTube at Investing Expat, or you can write me an email or visit my website. So at this point, we can open the floor to any questions. Mark, do you see any questions in the chat?
I do. Thanks very much for that, Tariq. That was very interesting. I enjoyed that. I've got one of my own, which then leads on to actually some of the questions that we've got in the chat. Is you mentioned at the beginning there the data that you saw there from CoinMarketCap, and I know that they publish. And you mentioned the size of Bitcoin versus Ether and others. Do you think that Bitcoin dominance is going to continue? Because I remember it falling a few years ago, but then it seems to have restored a little. I'm just wondering if Bitcoin will always be the king of the jungle.
Well, it's hard to say will always. It's kind of like with gold. If we go back 200 years, gold was money. And then, for my generation, I don't know how old you are, for my first 25 years, I only saw gold prices go in one direction, and that was down. Because certainly I think we've seen the 20th century was all about financialization, was about the rise of banks. So I certainly think there's a generational difference between how we looked at gold. Now, the whole life cycle, the whole period of Bitcoin and its supposed dominance, I believe is much, much shorter. If we look, for example, at the flows into Bitcoin ETFs versus, say, gold ETFs, both of them are up, both prices are up this year. But gold ETFs have actually seen outflows, while Bitcoin ETFs have seen inflows. My interpretation for that, quite simply, is that actors like Russia are using physical gold to avoid sanctions. They're, for whatever reason, not using Bitcoin. The primary driver of Bitcoin prices this year is that these ETFs have come onto market. Lots and lots of asset managers and others who wanted the ETF are just putting money into it, hoping that it will keep going up. My own view is that I don't think it's sustainable. I don't think Bitcoin is a great long-term, thing of any use or, way of running a financial system. There's a reason we got off the gold standard, last century. I don't think the right answer to people's concern about monetary system is a new, quote, gold standard, because that has all sorts of economic problems, which led us to the creation of central banks in the first place. Ether, like if you were to compare Bitcoin to Ether, one nice thing about Ether is that it's smart. You can create smart contracts on it. You can create a whole ecosystem. When people compare Bitcoin to gold, I think a better analogy for Ether is that it's like oil. In fact, in the Ether ecosystem, there's a term called gas fees, where if I were to, let's say, create a smart contract, we wanted to bet who was going to win the US presidential election next month, and it would actually be on there where automatically, if I win, 1 Ether gets sent to me. If you win, 1 Ether gets sent to you. That could be programmed on there, and the calculation is paid for with what's called gas fees using Ether tokens. You can build a whole ecosystem with that, with something like Ether, which you can't do with Bitcoin. I do my own view, and again, I could be wrong about this, like I am about a lot of things, is that those smarter tokens will take over because we, as people who like things that do things, would rather have a coin that actually does something rather than just sit around and provide what I call scarcity as a service. So that is my view. Again, I think it's very, who knows which direction things will go, but I use the history of gold as my my baseline.
Sure. One of the questions we have in is, what are your thoughts on the SEC stance on cryptos, particularly Ripple, XRP?
Well, I have to say I don't really have very strong views on it. I mean, the bigger, so there's a few different questions of how the SEC gets involved, and again, I'm not a regulatory expert. One is about wrapping them into securities. So, say having a Ripple ETF or an Ether ETF and so on like that, which has been a long battle, and there have been lawsuits, and I really don't think that's interesting, because I think taking these things and wrapping them into ETFs is like inventing the wheel and then taking it in a handbasket and carrying it around. The whole idea of Ripple is to process financial transactions more efficiently. And if you're then going to take 21st century technology and wrap it in 20th century technology and have a 20th century regulator deal with it, in my view, that's pretty backwards. Now, the SEC has another nexus on this, which is Ripple by itself a security? Should they be regulating Ether or Bitcoin or any of these things as securities? And the reason that they would do that, now, Bitcoin, I believe, I could double check on this. My understanding was a lot of it was not considered a security because Bitcoin acts a lot more like a commodity. But there are definitions of what makes something a security. Usually it's expectation of profits from the efforts about, there's definitions in there. There are legal definitions I don't remember off the top of my head. Bitcoin did not meet those definitions. A question for the SEC is, does Ripple meet those definitions? And if so, that would mean you would not be able to sell a Ripple token to an American without filing a prospectus, which again, I think brings back the question of what sense does it make to apply 20th century regulation to 21st century technology? How will these regulators stay up to date? And this is where I think there's going to be some really interesting competition between regulators around the world about which of these is actually going to guide this technology to make our lives better, rather than to just give us more bureaucracy and paperwork and hurdles. Something I deal with, quite regularly, unfortunately.
We've had a question regarding the it says, how has Bitcoin Friday influenced mainstream adoption of cryptocurrency? I mean, do you think that there could be this kind of reverse kind of derivatives tail wagging the underlying dog? Do you think that because of this, the wonderful kind of, the Bitcoin Friday futures and the lower margins that are required to trade them, and the liquidity that they still have, do you think that that would actually kind of spark an uptake in kind of Bitcoin itself?
Well, I think there are two different things. The whole point of Bitcoin futures is to trade Bitcoin prices. And there's a number of reasons why you might do it. You may have Bitcoin in a hard wallet that you're storing to keep things out of the financial system, but you may want to use these futures as a hedge so that huge price fluctuations don't affect you. You may quite simply see a new ETF coming or something else coming that you think is going to move Bitcoin prices one way or another, and you may just want to put a speculative trade on to profit from that. So the whole reason you use Bitcoin futures, whether Friday futures or monthly futures, is to trade the price. That's quite different from why I might use Bitcoin personally. Like you and I are banking in different countries. If for whatever reason I wanted to send you something without having to worry about wire fees or when the bank is open, probably one of the easiest ways for me to do it is to just send you a little bit of Bitcoin directly on chain. You don't have to worry about our banks knowing each other. There are real use cases for actual Bitcoin, which I was talking a lot more 10 years ago. And I feel now people aren't talking about the use cases as much as they are about the price. So if what you care about is the price, the futures are a very efficient way of trading it. If what you care about is actual applications of Bitcoin, then I think it's worth getting a hard wallet, going onto an exchange, and actually using these direct on-chain transactions in a way they were meant to be used.
Right, sure, yeah, no, that makes sense. Makes sense. Do you think that Bitcoin trades in a way that kind of other kind of traders would use the tools that they could apply to it, technical analysis or price action trading, that kind of thing? Do you think those same signals apply to Bitcoin futures as they do to kind of more traditional assets, S&P, FX, that kind of thing?
Well, they certainly could. I mean, I personally am much more of a fundamentalist, which is why Bitcoin is trickier for me because the fundamental value of the S&P 500 is something that makes sense to me. I know the 500 companies in there. I can see what their earnings are. I can see when those earnings are getting revised up or revised down. I can look at, say, treasury bonds. I can see what the yield is. I can see how economic news drives interest rates up and down. All of those things make sense to me. On the Bitcoin side, the only fundamental driver I've really seen is mining costs, and that is purely on the supply side. So what that means is the other side of it is demand, which is the one thing that's common in all markets. So technical analysis, what is technical analysis? It's a way of systematically looking at patterns of demand. So if you're a trend follower, you basically have the view that when you see an increase in demand, that's going to create more demand and that's going to drive a trend. And when you see demand falling off and you see people selling, that's going to create more supply, which is going to drive a downtrend. The nice thing about futures is you can use futures to apply that to almost any asset class. I could almost show you a futures contract and a chart, and you almost wouldn't care what the thing is. I guess that's one beauty of technical analysts or trend followers. The challenge I do think really is more on the fundamental side. I do not doubt at all that technical analysts are having a field day with Bitcoin prices.
Yeah, sure. And the volatility that you mentioned as well. Another question we have: what impact do you think the presidential elections will have in the future of cryptos?
Well, it's funny how it's even become an election issue. I mean, you saw Trump at a crypto conference, and he's been getting, and he's even talking about firing Gary Gensler being one of his first things. I actually don't think the impact of who's the president is really going to be that significant to crypto. I mean, a much bigger thing would be if there were ways of encouraging further adoption. One of the big problems I've seen pretty much since Obama came into office is that too big to fail and the power of banks has increased significantly. So the financial crisis, I actually thought was going to crack and fragment the banking system. And if you asked me in 2008, by 2024, would we have more smaller banks competing with each other so there's no too big to fail, or we would have fewer banks that were more too big to fail? And that second is what has happened. It is not at all what I would have expected. So those are the kinds of things I think to watch for long term. Now, neither of the candidates has openly said that they want to ban crypto, but it's not that long ago that you can see members of the Senate saying they didn't want Facebook/Meta creating a cryptocurrency where it would be as easy to send money as it is to send a photo. Now, is that because the government has a reason for wanting to keep things in the banking system, for trying to limit financial freedom, for trying to keep financial costs high? I'm sure a lot of conspiracy theorists will have views on that. I think that goes too far into conspiracy theory that I really don't think I can say much more meaningful about it. So short answer, I really don't think it's going to make that much of a difference. I think a Trump victory might be a little bit more pro-crypto, but not in a way that people would expect.
Sure. Okay, well, I think that we've reached a good stopping point there. I'd really like to thank you again, Tariq, for your time and wisdom sharing that. I'd also like to extend thanks to the CME for their partnership in creating these series of webinars. We have another webinar 2 weeks from now with Tariq, and we'll be discussing the S&P 500, NASDAQ and Dow Jones and insights for a smarter trader. So I would very much love to see you guys there. In the meantime, I hope the markets treat you well. Thanks very much for joining us today. Thank you again, Tariq, and have a good afternoon or evening. Thank you very much.
Thanks, Mark.